We are looking at a closed market right now with JPMorgan Chase Co. sitting at exactly 298.02 USD, having finished the last session down by 0.36 points or 0.12%. On the surface, a movement of 12 basis points feels insignificant, almost like the heartbeat of a giant resting between rounds. You might look at that red number and think the market is bored, or that the financials are simply taking a breather while the tech sector hogs the spotlight. But if you are looking at this flat line and thinking nothing happened, you are missing the most aggressive strategic maneuver currently unfolding on Wall Street. The expectation with JPMorgan Chase is always one of stability, a defensive play you hold for the dividend and the fortress balance sheet that Jamie Dimon has famously cultivated for decades. Investors generally believe that when you buy JPM, you are buying a safe harbor, a place to park capital that won't double overnight like Nvidia stock, but also won't evaporate. That is the narrative the street sells you. JPM is the boring, reliable uncle of the S&P 500. Here is the reality that challenges that entire thesis. JPMorgan Chase is currently executing a silent takeover of the digital financial infrastructure that effectively turns it into a tax collector for the entire fintech industry. While the market was fixating on that minor 0.12% drop, the firm has been finalizing agreements to charge third-party applications for access to customer data. Think about what that means. Every time a user connects their bank account to an external app, whether they're using SoFi Invest to track their net worth, funding their Robinhood stock trading account, or analyzing their spending on a budgeting tool, those apps need to query the bank's servers. For years, this data highway was free. Now, JPM is installing toll booths. This isn't just a bank. It is becoming a platform monopoly. The reality is that JPM is no longer just competing with the likes of Citi or Wells Fargo. It is aggressively cornering the online investment ecosystem by forcing its competitors to pay for the fuel they need to run. This transforms the stock from a passive value play into a compounding infrastructure play, something the current price of $298.02 barely begins to price in. Let's look closer at the recent price action because the charts are telling a story of immense coil tension. The stock has been hovering just under the psychological resistance of $300. When you see a stock tap a resistance level repeatedly, like JPM has done over the last 10 trading sessions, without selling off sharply, it indicates absorption. Sellers are stepping in at $300, but buyers are stepping up at $296, $297, and $298, effectively raising the floor. This price compression usually precedes a volatility expansion. The daily trading volume has remained consistent, which tells us that institutions are not dumping shares despite the broader market uncertainty. They are accumulating. The breakdown of the last session shows that the selling pressure was primarily algorithmic, triggered by broader sector rotation, rather than a fundamental exit from the stock. If we zoom out to the 4-hour chart, we see a bull flag pattern forming right below all-time highs. This is rare for a bank of this size. Usually, you see this kind of technical setup in high beta names like Tesla stock or Apple stock, where momentum traders pile in. Seeing this on a bank with a market cap exceeding $500 billion implies that the smart money is positioning for a breakout that has nothing to do with interest rates and everything to do with market dominance. The slight dip of 0.12% is essentially noise, a rounding error in a much larger accumulation phase. Now we need to discuss the elephant in the room, the competition for your investment dollars. The narrative for the last 5 years has been that traditional banking is dead and that everyone is moving to invest online through sleek, colorful apps. The assumption was that Robinhood and SoFi would eat JPM's lunch, but let's look at the data. JPM's self-directed investing platform has seen record inflows, effectively neutralizing the threat. They didn't just build a copycat, they integrated it into the banking app that 60 million households already use. When a customer logs in to check their checking balance, they are one click away from an individual brokerage account. This reduces the friction of self-investing to zero. Compare this to Schwab Intelligent Portfolios. Schwab is a fantastic platform, but it requires a separate mental bucket for the consumer. JPM sits in the center of the financial life. By offering intelligent portfolio options that rival the best robo-advisor services from SoFi, JPM has created a sticky ecosystem. If you hold your mortgage, your credit card, and your checking account with Chase, moving your investment account to Interactive Brokers for slightly lower margin rates becomes a hassle. You stay for the convenience, and that inertia is the most powerful force in finance. Furthermore, we have to talk about the Jamie Dimon Premium. There is a fear constantly whispered in the corridors of the NYSE about the succession plan. Dimon has been the CEO for what feels like forever, and his recent comments about his timeline remaining unchanged usually cause a ripple of anxiety. However, the market is getting comfortable with the idea that the bench is deep. The leadership team surrounding Dimon has been battle-tested. Unlike Tesla stock, which is heavily reliant on the singular persona of Elon Musk, JPM has institutionalized its brilliance. The fortress balance sheet isn't just a catchphrase, it's a doctrinal approach to risk management that permeates the culture. This is why, even on a down day like today, the stock holds its ground. Let's pivot to the broader online investing landscape. We are seeing a consolidation phase. A few years ago, there were dozens of investing sites popping up, promising to democratize finance. Now we are seeing a flight to quality. Investors who started on Robinhood the app during the 2021 boom are maturing. They are looking for investment help, tax loss harvesting, and wealth management, services where Fidelity and JPM excel. Fidelity Investments has done a tremendous job with their Fidelity mobile app and Fidelity trading platform, offering a robust suite of tools that appeal to the serious retail trader. Their lineup of Fidelity ETFs and Fidelity mutual funds is world-class, but JPM has a distinct advantage: the physical footprint. It sounds counterintuitive in a digital age, but the ability to walk into a branch and scream at a human when something goes wrong is a massive psychological safety net for high-net-worth individuals. SoFi Active Investing and Robinhood Crypto are great for digital natives, but when you're moving $1 million, you want a handshake. JPM has modernized its branches to be advisory centers rather than transaction centers. This phygital strategy, combining physical presence with digital excellence, is something purely digital players like SoFi or Interactive Brokers trading platforms cannot replicate easily. Speaking of Interactive Brokers, they remain the gold standard for the professional trader who cares about execution speed and Interactive Brokers' fees, which are incredibly low. The Interactive Brokers account types are complex and powerful, but JPM isn't trying to win the day trader who is scalping pennies on NVIDIA stock options. JPM is winning the mass affluent, the doctor, the lawyer, the small business owner who has $500,000 to deploy and wants it to be simple, integrated, and safe. This demographic is far more profitable than the high-frequency trader. Let's analyze the revenue mix that supports this $298.02 price tag. The investment banking division is waking up. For the last 2 years, M&A activity was in a coma due to high interest rates. Dealmakers were sitting on their hands. But as we look toward late 2025 and into 2026, the pipelines are filling. Private equity firms are sitting on record amounts of dry powder that they must deploy. When these mega deals happen, JPM is almost always on the ticket, collecting massive advisory fees. This cyclical upturn in investment banking could provide the earnings surprise that pushes the stock well past $300. Additionally, we need to consider the NII story. The common belief is that when the Fed cuts rates, banks lose money because their profit margin on loans decreases. This is true for small regional banks, but for a money center bank like JPM, lower rates can actually stimulate loan growth that offsets the margin compression. More businesses borrow to expand, more consumers take out mortgages. JPM's scale allows it to make up in volume what it loses in margin. Plus, their trading desk, the best in the world, thrives on the volatility that comes with rate regime changes. I want to pause here and ask you a question because this specific metric matters for the sentiment analysis.